Want to save money? Make sure you do these things before December 31st. Hey guys, it's Adrian here, the Canadian in a t-shirt. And today I'll break down the must-do steps before the end of the year to minimize your tax bill and maximize your money. We only have 2 weeks to prepare for the new year, so let's jump in. Starting with the FHSA, the brand new First Home Savings Account. It's designed to help Canadians buy their first home, and it combines the best benefits of both the TFSA and the RRSP. All the money you put into the FHSA is tax deductible. It lowers your tax bill just like the RRSP, and that money is invested and eventually withdrawn tax-free, like the TFSA. It's a total game changer, so please take advantage of it. And this is important. Make sure you open your FHSA before December 31st. Unlike the other tax-sheltered accounts, with the FHSA, you only start building contribution room once you actually open an account. So open the account, even if you don't put a lot of money into it. At least you'll be gaining that $8,000 of contribution room every single year until you reach the lifetime max of $40,000. As long as you open an FHSA account by December 31st, that $8,000 of unused contribution room for 2023 will be carried forward. So on January 1st, 2024, you'll have a total of $16,000 worth of FHSA room. Instead, if you wait until January to open your account, you miss out. You'll only be able to contribute $8,000 for the year. Don't make this mistake. Remember, you can keep the FHSA account open for up to 15 years. Even if buying a house is not on your radar, 15 years is a long time. So if there's a good chance that you'll buy a house in the next 15 years, please open an FHSA account before December 31st. And you don't have to max it out with $8,000. Contribute what you can. Whatever you put in will give you flexibility with your taxes. If you contribute $1,000 into your FHSA before December 31st, now you get a choice. You can either claim that $1,000 tax deduction against your 2023 income to lower your tax bill, or you can carry it forward to a future year and collect even bigger tax savings if you expect your income to grow. You can carry forward this FHSA deduction the exact same way as an RRSP deduction. I have a whole video breaking down this strategy. Check it out. A lot of the banks still don't offer FHSA accounts, so I recommend opening an account with Questrade, my favorite broker. Questrade was the only institution ready for the FHSA on day one. And you only need $250 to open an FHSA account with them. Watch this for a step-by-step tutorial on how to open an account and all the rules to follow. And make sure you use my referral link below to get that $50 sign-up bonus. Up next, we have the RESP, the Registered Education Savings Plan. This is another tax-sheltered account to help fund your child's post-secondary education. College and university is more expensive than ever, so investing in the RESP can make a huge difference, especially with the free grant money from the government. Here's how it works. Whatever money you put into your child's RESP, the government will match 20% of that in grants, up to $500 every year. That's free money, so take it. Here's the strategy. Try your best to contribute $2,500 per child every year into the RESP. That way, you'll earn the maximum $500 of free money every year. Keep that up, and after 14 years, you'll reach the lifetime max of $7,200 of grants. Don't miss out on this free money, so it's important to make this $2,500 contribution by December 31st. If you miss a year or can't contribute the full $2,500, that's okay. You can catch up on these grants, but only 1 year at a time. Meaning, if you have unused grant money, you can put in up to $5,000 into the RESP and collect up to $1,000 in grants. But this should only be used as a backup plan if you miss a year. The best approach is to put in $2,500 per child every single year, but do that before December 31st. That way, you're guaranteed to collect that $500 grant. If you wait until January, you miss out for the year, and you might not get those grants back. There are a lot more rules to cover. In fact, I have 2 entire videos called RESP Explained, so give them a watch. I'll put the link down below. Next, we have the TFSA, the Tax-Free Savings Account. This is by far the most flexible account. There aren't any strict deadlines for TFSA contributions. If you don't max out your TFSA, that unused room gets carried forward, so it doesn't really matter whether you contribute in December or January. What does matter is when you withdraw from your TFSA. That timing is very important. If you need the money and you know you're going to withdraw from your TFSA, it's best to do it before December 31st. Here's why. When you withdraw from your TFSA, you can't put that money back for the rest of the year. But whatever amount you withdraw, you regain that contribution room on January 1st. Let's say my TFSA is maxed out and I need to withdraw $2,000. For the rest of the year, my TFSA is still maxed out. I can't put in a single dollar until January. If I withdraw in December, I only have to wait a few short weeks, and then on January 1st, I regain that $2,000 of contribution room plus the $7,000 of new TFSA room that everyone gets for the new year. Instead, if I wait until January to withdraw that money, I'll need to wait an extra 12 months until next year to regain that contribution room. Here's the bottom line. December is the best time to withdraw from your TFSA. January is the worst. So if you need to withdraw, do it before December 31st. The RRSP, the Registered Retirement Savings Plan, has a different schedule. It doesn't follow the calendar year, January to December. Instead, the RRSP calendar starts on March 1st. This means that any RRSP contributions in the first 60 days of the new year count towards your previous year. That's a good thing. This way, we gain an extra 2 months to run the numbers and make a plan to lower our tax bill. If you had a high income in 2023, you can contribute to your RRSP by February 29th, and that deduction will lower your tax bill. So you'll receive a tax refund when you file your tax return in April. You don't have to contribute to your RRSP, and if you do, you don't have to claim that tax deduction right away. If you'll be in a higher tax bracket next year, you can carry forward that tax deduction and enjoy even more tax savings. Watch my RRSP guide for more great tips. Just keep in mind the RRSP deadline. Since 2024 is a leap year, the deadline is February 29th. Any contributions after March 1st will go towards your 2024 tax year. And for all of these deadlines, please don't wait until the last day. Contributions and withdrawals can take 1 or 2 business days to process, so plan ahead for that. Make sure you watch my year-end tax saving tips. It's a 15-minute video full of important strategies that I use every year in December to minimize my taxes. I break down tax loss harvesting. That's basically when you intentionally sell a stock at a loss to reduce your tax bill. The superficial loss rule, transferring between tax sheltered accounts, and more. This will be my last video for 2023, so thanks everyone, and I'll see you guys next year on the Canadian in a T-shirt. Bye guys.